Hello and welcome to the show. I'm Jon Jordan, and today we're taking a deep dive into the financials of US retailer GameStop. So there's lots of discussion always about GameStop at the moment. GameStop runs lots of retail units, mainly in the States, but also has a reasonable international spread, Canada, Australia, and parts of Europe. Um, and it sells games through its stores. Now, clearly, that is a business that's under lots of pressure. So part of the pressure comes from the digital distribution of software in particular. So likes of obviously Sony and Microsoft, EA, Activision now have their own online platforms for distribution. And clearly, on the other hand, you have the likes of Amazon, so online retailers. And as a specialist retailer of kind of games, hardware, software, and other peripherals, GameStop has come under fire really from the investment community. Certainly market sentiment has been very down on its stock recently. But let's not worry too much about it at the moment. Let's just look at some numbers. So the graph we have in front of us now is GameStop's sales over the last 10 years. So I've broken these down into various colors so we can see what's going on. So there's blue, new hardware sales. You see new hardware sales are always a smaller part of GameStop's business. And actually they're quite a low margin, so about 10% margin on selling new hardware. That's blue. In red we have new software sales. So new software sales have traditionally been the biggest single category for GameStop, anything between kind of $2.5 to $3 billion of annual revenue. Margin on that is about kind of 20 up to 25%. Now I have the interesting bit, at least for me, is the orange, yellowy orange. So that's the pre-owned. So what's very interesting for GameStop is it has this pre-owned software. So if you go in and you spend $60 buying a game with GameStop, you can then, after you finish playing the game, go back and basically trade the game in for another game, and then GameStop takes that stock and then resells it. So this is actually now kind of running neck and neck with new software sales for GameStop, partly because new software sales have been dropping in recent years. So the pre-owned software, and actually to do pre-owned hardware as well, that's running at about $2.3 billion of revenue. Certainly it was for the for 16 financial year 16-17. The really good thing for GameStop is the margin on that is getting on for kind of 40-50%. So that's its very strong margin element. And then in green, which we'll go into in more detail, we have this thing kind of other categories. So at the moment we have digital. It does some digital, pure digital. Selling of games, not very much, $151 million last year. Tech brands is its expansion into mobile devices and collectibles, and we can see there that the green, the other element is becoming a much bigger part of GameStop's business over the years. But kind of final takeaway on this graph, we can see 2016-17 was a significant decrease on the previous year. Overall sales down about over 8% actually. So that's kind of the trend that in a sense people are expecting, because the specialist company is coming under pressure in lots of different ways on its core selling proposition. So we've seen what's happened to sales. Let's now have a look at net earnings, which are a bit more interesting, I guess. So in terms of its profitability, again over the last 10 years we can see from this graph what's been going on for GameStop. Couple of things to point out. We actually have 11 years here, so the column on the far right, that is the prediction for the current financial year, and the one for financial year 12-13. Actually the company had a large impairment in that year, so basically an accounting loss. So we can see it was a $627 million impairment. So effectively it made a loss that year, which is why the blue column is negative. But if you strip out the impairment, actually the kind of underlying net earnings of the company were kind of fit into the trend we've seen. So for the last 10 years, GameStop has generated over $250 million of net earnings, so strongly profitable. Obviously it's gone up and down within that level. The highest it's been over $400 million. Last year it was just over $350 million. The guidance for this year is potentially down to $320 million, but or equally could be the high guidance is about the same as last year. So the other thing to point out is even though we've seen a declining trend, or starting to see a declining trend in terms of GameStop's sales. Um, Net earnings are still strong, maybe not at the kind of level they were in 15-16, and we can see there, and that was one of its strongest years. So in 16-17 they declined a little bit, but we're not in anything like a loss-making situation. So the company is certainly under pressure in some of its kind of key channels, but at the moment earnings are holding up. So what's GameStop been doing with all this money it's been earning? Well, some of it's gone back to paying debt. So you can see the blue column there. GameStop took on a whole bunch of debt to expand, particularly in Europe. So that had to be paid back. That's obviously was paid back a while ago now. And then in red we have quite an aggressive share buyback program, so over $2 billion spent on buying back its shares, which then obviously eliminates. So it's eliminated 61 million shares over the last few years, and that helps in terms of earnings per share, because there's less shares to compare against, particularly if your earnings are starting to decrease. That's good. And actually, GameStop still has $170 million in its current share buyback program. So that's what the board had a program of $500 million. 170 still remains. And then over the last 5 years, we've seen dividends. So dividends are basically a company giving money to shareholders to continue to hold the share, effectively like a often seen as interest. A bit more complicated than that, because it obviously the yield depends on whether the share price is going up or down. Despite spending all this money kind of trying to keep its shareholders happy, GameStop shares have not been doing very well over the last 3 years, down 60%, even over the last year down kind of 25-30%. So partly this is this kind of market sentiment around GameStop, that people are worried that its kind of core market is under pressure, and effectively at some point, you know, the really bearish people think the company will go bust, because just why would you go into one of its stores and buy a game disc when you could just download it onto your console? So that's what GameStop's management's been dealing with, and that's what we're going to move on to looking at next. In 2013, GameStop said it was going to make a radical change to its business model. It wasn't just going to be a game retailer, it was going to move into other markets. And this is something we can see on this graph. This is a graph of where GameStop's shops are and what they sell. So in blue, still, you know, the vast majority of GameStop's retail is in the US and sells video games. Actually, within that, there's been quite a change in terms of the stuff it sells. So a lot of those stores now also sell prepaid mobile, particularly the under the Cricket brand, which is an AT&T prepaid brand, and a lot of them also now sell collectible items, so kind of figurines and kind of t-shirts and all that kind of branded stuff, and that's all related to games and stuff like Game of Thrones and kind of like you know, kind of pop culture type stuff. So even within those stores, there's quite a lot happening. But anyway, video game stores are still GameStop's main retail. We can see in red it has about just over 300 stores in Canada. Has actually quite a strong footprint in Australia, so that's games, and it has also standalone collectible shops, so shops just selling these collectible items. They tend to be smaller stores, but it's expanded quite a lot in Australia. About 400, just under 450 stores in Australia. In green we have Europe, so in all the major European countries apart from the UK and Spain, GameStop is quite big in Europe. And then we have this interesting purple kind of stack, which starts in 13-14. So that's from the time when GameStop started saying we're gonna kind of diversify out of games. And we can see that if we remove the purple, GameStop its store total would have dropped, and actually dropped quite significantly. But because it started opening these new stores, it now has in the tech brand kind of sector, has over 1,500 stores, being quite aggressively opening over the last 2 years. So actually its store count has actually increased quite a lot. So it's well over 7,500 now. So despite what some people think about GameStop and the decline of retail, GameStop has kind of decided, its management have decided, the thing it does best is retail. So while its game market is under pressure, but continues to be very profitable, so we'll definitely see a decline in game revenue. Quite what impact that will have on kind of game earnings, hard to tell at the moment. But what GameStop's management is thinking is we start selling other things, so particularly mobile devices. It also has a chain called Simply Mac, about 50 of those shops, and they're basically kind of unofficial Apple stores. So they're located in places that don't have official Apple stores. So they're selling iPhones and Macs, that kind of stuff. So diversifying out of games, selling effectively consumer electronics and collectibles. That's where GameStop's management thinks it can kind of overcome the decline in games over the coming years. With this graph, we can see in a bit more detail what's been happening to GameStop's shops over the last 3 years. So as before, blue is game stores. So we can see game stores, it has been opening some, but the net change has been shutting a lot. So shutting over 100 stores, in some cases over 200 stores a year from its game portfolio. And then we can see in orange yellow, that's the tech brand stores. So these are there's 3 different store brands. So there's the Cricket Wireless, and there's Spring Mobile, which are both AT&T brands that GameStop works with AT&T on. And then there's also this Simply Mac, about 50 of those. So we can see here in financial year 15-16, a lot of stores opened. Actually, these are stores that GameStop has opened and it's acquired. So it's been acquiring stores from other retailers and kind of rebranding them. And then we see much smaller, but it's actually still generating a lot of sales. Actually, are the collectibles. So that's in red. And then we can see the green line is the total net store openings. So we can see here, even for the last 4 years, even though it's been shutting down the game stores, it's still effectively been net positive, and GameStop has more retail outlets than ever before. But this transformation has come at a cost. So GameStop has opened all these new stores and acquired these stores, the tech brand stores, by taking on debt. So it now has $825 million of debt that has to be paid over the next 4 or 5 years. So we can see there, in this graph under the line, we've got the red is the debt. So as we saw in a previous graph, there was some debt that it paid off. It didn't have any debt then for 3 years, and now it's taken on this extra debt. And obviously it has to pay interest, so it has interest on the debt, about $50 million a year at the moment, and then it has to pay off the principal as well over 2 stages. So a lot of debt. The blue kind of area there is what we saw, again, what we saw before, how GameStop has been spending on debt repayment, on dividends, and on share buybacks. And above the line, we have just kind of 2 metrics for well, kind of cash, or you can see there, so the green line is cash and equivalent, so effectively how much cash it has in its bank account. And then working capital is a kind of a similar kind of measure, but looking at kind of operational spending. We can see in both those cases the trend is downwards. It goes up and down over the years, but in general it's downwards. That's partly because GameStop has been spending quite a bit of money on buying back its shares, and partly because it's, you know, under pressure at its core business. And this kind of becomes the kind of issue that is really surrounding people now. It's got this debt. Its games business is in decline. No one knows quite how quickly it will or won't decline. That will have a knock-on impact on net earnings. If net earnings go down, I don't think it's going to be at the level that it can't pay back its debt, but clearly people are worried about the dividend. Will it be able to pay the dividend? Share buyback, probably, even though it has $170 million still left in its current program, I would imagine it will not be spending money buying back shares at the current time, or certainly not anything significant. It would be, I think, dangerous given market sentiment around GameStop already for it to start dropping its dividend. It has been increasing dividend every year. That might stop, but it's you can see kind of GameStop is in an interesting situation over the next couple of years, just because it's trying to kind of, in a sense, kind of rebuild the aeroplane in flight. No one's quite sure what's going to go on with the games side of it, and while the new elements are doing well, can they be spun up quick enough to kind of replace the profit that's being lost? Because really, sales don't really matter. It's really about the profitability of the company, and that's really where the focus of investor attention lies. So a final graph to highlight really deep down what's going on in GameStop's business. So this is over the last 3 financial years, and it breaks down individual components. I won't go into total depth on it, but just to point out, so as we've seen before, the blue is new hardware sales. So new hardware sales were up 3 years ago. This is all year on year, and then have been down since then, significantly down. So we can see over $500 million down in the last financial year. Obviously, GameStop's not really in charge of, isn't really in control of that market. That depends on when new hardware comes out. This year, we've seen the Nintendo Switch come out, very popular. So this year will probably be okay. GameStop, I imagine, it will definitely see hardware sales up. Also, the new Xbox, the Xbox One X, the new uprated Xbox comes out in November. So not kind of hard to tell how many people will be buying that, but this will be a good year for hardware, and probably next year as well. Reasonable year for hardware sales for GameStop. Although, as we noticed, hardware is a low margin part of the business. More worrying, but kind of expected because it's the industry trend, is the red column. So that's new software sales, new game sales, down year on year for those 3 years, and quite sizably down in 2 of those years. So $400 million down year on year. That's kind of the worry, I suppose, because that's the part of GameStop's business that people can just download directly to their console or PC. Again, there is some kind of seasonality or some cyclic behavior in that. It depends on what the big games are that are coming out. This year, again, partly because of Switch and partly because of other kind of issues, there are some big games coming out that potentially weren't out last year. Last year wasn't very good for big blockbuster games. This year's better. So we may see an uptick for financial year 17-18 for GameStop. I guess on the other quick things to look at are the things that are doing well for it. So the things are doing well. Obviously, it's taken on all this debt for tech brands and collectibles, and we can see the kind of lighter blue and the pink. Obviously, they're up year on year. That's because GameStop's opening more stores, so that's kind of no surprise that sales are going up. But doing well, as we can see. I guess the green bar at the end shows the net. So of all the different components, is it going up or down? So for the last 2 years, we saw sales going up. That was because the opening of the new tech brand and collectible stores was overcoming the drop in game sales. In financial year 16-17, they didn't, so we had this big decrease. The other thing to point out is the change in pre-owned sales. So that's the yellow-orange. Now that's not been changing so much, and I think this is kind of one area that is often overlooked by people. So the fact is, this kind of over $2.3 billion of sales last year, that will decline. But once people have a game that they're not playing anymore, they will want to use that as credit. And for a certain segment of the market, people who don't have so much money, that's quite valuable, and that actually gives GameStop differentiation against Amazon. You can buy a game from Amazon, but you can't take it back to Amazon to get money off your next game. You could eBay it, I suppose, but it's much easier to go back into GameStop and get $20 off your next game by swapping it in, and then obviously that game can be sold to someone else at a lower cost. So I think that the pre-owned business that'll be really the most interesting thing to see over the next couple of years. That could really help, and particularly because that's the high margin part of GameStop's business. So we might see quite a significant decrease in revenue overall, but we might see earnings holding up much better because of this pre-owned segment. So anyway, lots to talk about with GameStop. It's a very interesting company in an interesting situation, and I think financial year 17-18 will probably be okay for it. I think that it has some good headwinds there. It's going to be the next year that's going to be the real kind of interesting kind of time to see what's going on with the metrics. So don't forget to subscribe to the channel. This is the kind of stuff we do, these deep kind of financial looks at game companies. So if that's your thing, hope to see you again soon.